So a few weeks back, I looked at what is expected from private equity within the upcoming year, and we've just ended Q1, and there's a few reports coming out from, well, on a global scale, and then also from the Americas and the EU. And in a private equity market into 2026, expecting really a continuation of the 2025 recovery, but instead we've seen volatility really defined by shifting monetary policies, geopolitical shocks, and the continued long tail impact of artificial intelligence. So, looking at some latest reports on Q1 from the US and then also from Europe, this really provides us with kind of a window into what some of these effects means. And we really look at we're going to see a few trends of what's come through from a in essence a collapse from the in software valuations, a rise in hard asset deals. We see widening credit spreads. We see continuous deal structures and growth of evergreen funds. And I'll briefly touch on. We'll unpack this in a little bit more detail, but we'll also explore what these shifts really mean in how it's reshaping business and also investor behavior. I think broadly speaking, I think the first thing I want to touch on is AI turbulence that's challenging software private equity dominance. So in the US, the year began with AI fueled sell off in some public SaaS sectors. We saw headlines declaring that AI agents will replace per seat licensing and really kill software, prompting a sharp value reset and turmoil in the private credit markets. But we saw from a few reports and the latest from PitchBook that leading private equity investors are argue software's death is greatly exaggerated. So while many software businesses remain viable, uncertainty over their business model threatens software's dominance as private equities go to strategy and raises questions about the massive inventory of existing software holdings. In Europe, the SaaS sector mirrored these pressures. So private equity deal value in SaaS fell by about 38% year on year, and deal count fell about 28%. So we also saw then the release from Anthropic's agentic AI tools in February triggered a reassessment of the SaaS models. SAP's the SAP 500 software index dropped by 13%. But again, I think we can see I guess, from some of the reports warns that this re-rating of listing software multiples will definitely feed through to private valuations, making sponsors much more selective. Now from a business and investor perspective, portfolio companies in software must pivot from licensing to service centric models. So AI tools may reduce the per seat revenue, making it's imperative to embed AI as a value add rather than a disruptor. So private equity investors will need to reinvest in R&D and product diversification to preserve those markets. Investors should expect, I think, slower exits, slower value or lower valuations for existing software holdings as debt refinancing becomes harder, credit spreads widens, sponsors may be forced to either accept lower returns or inject additional equity. So the screening process for new software investment will definitely focus on data moats and regulated verticals from a protection perspective. The second key trend, and it's something I touched on now, was this hard asset sectors is definitely seizing the spotlight. So your heavy assets and low obsolescence as a subsectors as like energy, materials, chemicals, and industrials. We saw from 2016 to 2024 that these halo deals represented 10 to 15% of US deal count, and in Q1, halo capital deployed surged about 31% of all PE capital, propelled by large take private deals. So this standout transaction, there was a few standout transactions, EQT and GIP, which is north of 4 billion. We also saw, and this is all electrical generation companies. We also saw Apollo doing deals. We also saw Clear Channel and Lone Star, also 6 billion and 3.8 billion. In Europe, saw a similar pivot. Mega deals accounted for 37% of total deal value. This is the highest share since Q2 in 2022. Sponsors also formed club deals to syndicate risk. These deals made up 43% of buyout value, and add-ons reached a decade high of 71% of buyout count. So this signals that investors prefer consolidating existing platforms over launching new ones. Businesses in these sectors, so in utilities, industrials, infrastructure, obviously will benefit from capital inflows. Their tangible assets and regulated revenue streams offer low obsolescence, making them attractive in an AI disrupted world. So companies should be prepared for increased due diligence as sponsors syndicate deals and focus on operational resilience. Investors should diversify, or we will see diversification to these heavy asset sectors to counterbalance the software exposure. Hard assets deals often require larger equity checks and longer hold periods, and investors will have to assess whether funds have the operational expertise to manage these complex asset and, of course, navigate the environmental, social, and governance risk associated. A third broad theme that has come through quite strongly in Q1 is the credit market stress and then the widening spread. So we saw in the US spreads of broadly syndicated loans widening up to 100 basis points. This came through in February and March. We also saw even higher quality borrowers experiencing widening. So your double B minus deals widening 58 basis points. So again, we're seeing credit spreads widening across the board. This also means, or the effect of that has also been credit market activity slowed, with Q1 activity of around 260 billion across 2,400 deals, and this is the softest quarter since Q2 2025. Primary leverage loans issuance were 34% behind last year's pace, with refinancing and repricing activities also down about 40%. However, net new issuance held up much better. So M&A driven financing totaled about 51 billion, the strongest opening quarter for M&A related to BSL issuance in about 4 years. Europe faces slightly different drivers. The Iran conflict, the conflict at the Strait of Hormuz, threatens obviously energy prices and inflation, prompting central banks to pause rate cuts and talking about increases. So again, if energy prices remain elevated, borrowing costs will rise and also compress returns. So in essence, businesses must brace themselves for higher interest expenses and less forgiving refinancing conditions. The credit environment favors high quality borrowers. Companies with weaker credit profiles may need to pursue smaller add-on transactions or consider equity injections rather than large leverage transactions. Investors should and have started adjusting their hurdle rates based on return expectations, also with this widening credit spread being seen. And this signals that credit markets are pricing risk more discriminately. So allocations to private credit need to be much more selective, focus on sectors with durable cash flows. The fourth key theme coming through, and this again something I've already touched on briefly, but is deal making has slowed, but selective structures still is still attractive. So your US deal making recovery really stalled in Q1. As I mentioned, roughly 2,500 deals with 260 billion in deals concluded, but this is a sharp decline from the north of 330 million seen in Q3 2025, and also in Q4 2025. So the slowdown is attributed to these macro uncertainties, widening bid-ask spread, and sponsors' willingness to hold assets rather than to sell at lower multiples. Europe deal value also fell 22%. Deal count is down 21%. Add-ons and club deals still dominated, while your new platform deals were also limited. The largest European deals was of InPost at about just under 8 billion. And this underscores that many of your mega deals were already in motion before the Iran conflict. But how that carries forward going forward over the next few months will be key to monitor. Take private deals remain a bright spot. US take private value rose 13-year quarter on quarter, 53% year on year, reached about 64 billion. Even though deal count declined. So we should see, I think, especially on the software side, some good pipeline coming through on the take private side. Businesses looking to sell must anticipate longer sales processes and increased buyer scrutiny. Investment committees now demand much more rigorous downside analysis and clear separation of pre-COVID surge period and normalized financial results. So sellers must craft a very defensible equity story backed by detailed data and segment performance. Investors will see, I think, larger average deal sizes as sponsors pursue fewer, bigger opportunities. But this also means club deals and co-investments create opportunities for LPs to access large transactions, but also require alignment on governance and risk sharing. The fifth key theme that has come through is around fundraising and the rise of the evergreen fund or capital. US fundraising remains subdued. I think only around 84 funds closed through Q1, raising about 55 billion. And then the 10 largest funds captured around 64% of the capital. So near-term private equity returns have moderated. 1 and 3 year IRRs have fallen down from almost halved from the long-term average. Limited partners have constrained budgets due to a 36% decline in annual distributions, leaving many smaller funds struggling to raise follow on vehicles. In Europe, fundraising environment is similar. Only 23 funds closed in Q1, raising about 18 billion, with the most capital flows to mid-market strategies. And the first 5 billion fund in over a year, closing at I think it was Triton Partners. So year 2 growth equity is showing signs of life as stabilizing rates ease valuation headwinds. This will probably likely change as rates are looking to go up again. But that's at least what played out in Q1. Major sponsors are also turning to inorganic growth, shifting from structural shifts towards platform diversification, which also gives some good tailwinds. Semi-liquid evergreen funds are scaling rapidly. The US net assets across interval and tender offers exceed about for 57 billion. We saw Blackstone, KKR, Semi-liquid PE funds now manage nearly 20 billion each, with 1.5 billion in flows. And these vehicles offer monthly subscriptions and redemptions, increasing liquidity by creating pressure to deploy capital quickly and raising raising transparency concerns. So yes, interesting space to watch, and we'll see how the rest of the year pans out. Businesses may benefit from evergreen fund deployment pressures, as these vehicles must invest continuous inflows and may accept lower returns to avoid cash drag. However, your evergreen structures often co-invest alongside your traditional funds, raising questions about allocation, conflicts, and your GP focus. Investors, I think, recognize that fundraising market is bifurcating. Capital concentration among mega funds may create zombie funds among your smaller fund managers, while your evergreen products promise smoother capital calls, but potential lower long-term returns due to urgency of deployment. And so LPs must be diligent. The diligence on the semi-liquid vehicles holdings and valuation practices, and adjust portfolio construction to really accommodate those slower distributions. Of course, exit markets is also something key to watch. Very much about liquidity bottlenecks and then alternative routes. The US exit activity remains muted. Sponsors have been reluctant to sell at lower multiples, leading to the use of continuation vehicles and secondaries. Distribution rates for buyout funds declined 25% of NAV historically to from around 25% to 16% between 2022 and 2025. Europe exit market also slowed. Exit value fell 9.5% and account drop of about 31%. Your mega exits represents pretty much 68% of exit value, leaving your mid-market exits very subdued. Sponsor to sponsor sales dominated, accounted for roughly 76% of total exits. But there's also new avenues being explored. So the UK's regulated trading platform, allowing private companies to open time-limited share windows, hint at some alternative liquidity solutions coming to market. But again, something to watch. So businesses should expect longer holding periods. Sponsors are increasingly using their continuation funds and secondaries to provide partial liquidity, which may delay full exits. European market can explore platform like BICs, etc., to access liquidity without a full IPO, but we have to watch this space. Investors need to monitor valuations carefully. High resilience on sponsor-to-sponsor transactions may inflate the valuation market and obscure kind of the true price discovery. Patience and diversification across geographies and strategies really become critical. So based on what we predicted last year, based on what we've seen from Q1, I think Q1 US and Europe private equity trends reveal a market that's really at an inflection point. AI-driven software disruption, geopolitical shocks, tightening credit conditions, and are forcing private equity to reallocate capital toward hard asset sectors and embrace novel structures such as your semi-liquid funds. Deal making has slowed. Fundraising them remains selective, and exit channels are constrained. Yet opportunities persist for investors who are able to adopt. For businesses, capital is available, but it's more discriminating. Companies must articulate really a compelling growth and resilience story, embracing operational improvements and be prepared to extend hold periods. Your hard asset sectors may benefit from renewed investor attention, while software companies need to evolve their models to survive the AI era, in reality or just from a narrative perspective. Investors, I think the private equity's traditional playbook relying on multiple expansions and abundant credit needs recalibration. diversification across sectors and geographies, a deeper focus on operational value creation and willingness to engage with new fund structures will be the key to capturing returns in 2026. So the shifting landscape demands thought leaders that acknowledge the risk, embraces innovation, and remains grounded in true rigorous analysis. Looking forward to obviously exploring the market further and how Q2 manages out. I'll also do a follow-up video where we just explore some mid-market and some emerging market trends also focused on this backdrop. But thank you for listening.